So, what should the current price of gold be? Hello guys, welcome back to my YouTube channel. In this video I'm going to be discussing a model I came up with to estimate the price of gold depending on the current money supply of dollars in the US economy. So I'm going to turn you over to a notepad here where I'm going to explain to you my model. So the model I came up with was gold price. Gold PRC stands for gold price. Is equal to beta naught, which is the intercept, plus beta 1, which is a slope, times the money supply of dollars, plus U. So this formula explains how the money supply impacts on the gold price by timesing the money supply by this number here. I know what these numbers are, I'll tell you what they are in a minute, but first I want to explain what this is. This includes other factors other than the money supply that affect the gold price. So if I were to write the full formula, it would be much longer. So let's just put gold price equals beta naught plus beta 1. So instead of writing the whole thing, I'm just going to write MS for money supply. So if we were going to include more factors, for example, if we're going to include the inflation rate, that has another impact on the gold price. Inflation, I for inflation. Also, another thing that has impact on inflation is on the gold price is the level of FOMO, so fear in the market, fear of missing out. So another thing that affects the price is the substitute investment options. So there's many things people can invest in, like stocks, bonds, and many things. So those things influence the gold price. So this list goes on forever because there's an unlimited amount of things that impact the gold price. In order to simplify the model, what we do is we put all of these things into this. So it simplifies it into this model. Because this list could go on forever. But, so now forget about this one. I'm going to tell you what the numbers for beta naught and beta 1 are. So the way I obtained these numbers was I got a list of the gold price over the last 20 years for every week of the last 20 years. So 52 weeks for the last 20 years. That's how many gold price lists I got. And I also got the money supply for the last 20 years every week. So 20 times 52. So that's how many observations there were for the gold price and the money supply. And when I inputted this data, so let me just show you the example. So these numbers would be, so let's say G for gold price, MS for money supply. So for last week, let's just say week 1, the gold price was, let's just say 1900. The money supply was, let's put X just to denote it. And the week before that, it was, let's say 1800. And X. So I got this 52 times 20. So this list goes on over 1,000 times. So forget that now. So I'm going to tell you what this is. After plugging this data into a software called eViews of a list of the history of the last 20 years of the gold price and the money supply, I got a formula for the gold price. So the gold price equals 704 plus 0.126 times the money supply plus U. So this says here that the gold price should be equal to $704 plus the money supply times by 12%. So the money supply is measured in thousands of billions. So Guess what the current money supply of the US is? How many dollars are circulating around the US economy? Well, there's not 1 billion. There's not 10 billion. There's not 100 billion. There are not 1,000 billion. But there are 19,000 billion dollars circulating the economy. In other words, there's 19 trillion, but we're just saying 19,000. So we forget about that. We put the 19,000 number into this, and we will get a prediction for what the gold price should be at the moment. Because the current money supply is 19,000 billion. There's currently 19,000 billion dollars circulating the US economy, or 19 trillion, however you want to say it. But so if we type that in, if we cross that out and put 19,000, we do it in the calculator, we should get what the current gold price is, what the current gold price should be. So plus 0.126 times 19,000, we get 3,000. So the gold price should be 3,098. That's what the gold price should be. But currently the gold price is $1,994. So what's the difference? That's what the gold price should be based on the current money supply. And that's what the gold price is. So if we just minus the difference, 1994, see that's a $11,104 difference between these two. So that's how much higher the gold price should be. It should be 3,098, but it's 1994. So that's an extra 1,104. So why is the gold price not this, and why is it this instead? Well, that's because of the it's because of the things contained in here. Because the other things have more influence on the gold price than the money supply does. So if the money supply had influence, if the gold price was purely an influence of the money supply and none of the other things, then the gold price would be 3,098. But there were other things included, such as the level of FOMO. So we talked about F for FOMO, yeah? If we were going to rewrite the model, let's say GP, gold price, plus beta 0 plus beta 1 times the money supply, plus beta 2 times F, plus U. Do you think that FOMO, the level of fear of missing out of buying gold, is higher than it was 10 years ago? No, it wasn't, because 10 years ago was not long after the 2008 financial crisis. So the FOMO would have been a lot higher. Let's just say it was 10. Let's just say it was 10. It wasn't 10, but it probably was. Let's say FOMO was 10. But let's say this year FOMO is 5. So the level of FOMO is different compared to previous years. So even though the price should be 3,098 based on the current money supply, compared to previous years of 20 years of data, and 20 years of data on the money supply and the gold price, it isn't 3,098 because of this number being lower. This number is a lot lower than it was in previous years, and that may be down to a lot of things that go on forever, that makes the formula go on forever. So that could be substitute investments. So the stock market. What percentage of people prefer to invest in the stock market compared to the gold market? What's the ratio? What's the ratio of, let's say, the gold market cap compared to the stock market cap? What's the difference compared to 2023 and 2008? It must be a lot lower. So there must be, let's say in 2008 this was 100 and this was 90. But now it could be that could still be 90, and that might be 80. So the substitute investments also impact the gold price, and many other things do. So anyway, guys, I hope you found this useful. That's what the gold price should be based on previous data on the money supply. But it's important to take these numbers with a grain of salt, because there are other factors in you that influence the gold price. So anyway, guys, hope you enjoyed this video. Please hit the like button and the subscribe button, and I'll see you in the next video.